When most people hear the phrase housing bubble, Pennsylvania usually isn't the first place that comes to mind. For a long time, the state was marketed as the safe, dependable middle ground. Nothing explosive, nothing catastrophic. Just rows of brick homes, aging mill towns, hospital-centered cities, and calm suburbs that supposedly never lost their footing. But that long-standing narrative is starting to crack. Across Pennsylvania, the market is shifting in noticeable ways. In some cities, price reductions are stacking up, sellers are repeatedly lowering expectations to keep pace, and buyers are gaining leverage they haven't had in years. Some of these places are former industrial hubs that never truly bounced back. Others are college towns and commuter cities that stayed out of the spotlight while prices quietly climbed beyond what local paychecks could realistically support. This is Discover the Cities. If you want to spot the fault lines before they become front-page news, make sure to subscribe now. Today, we're breaking down 10 Pennsylvania cities where home values are dropping quickly, and where a single bad decision could leave you stuck in a market that's shrinking while everyone else is racing for the exit. Let's kick off the countdown. Number 10. Lancaster. Lancaster earned its reputation through charm and character. Brick-lined streets, historic row houses, and a blend of small city buzz with rolling farmland just beyond the city limits. For a long time, it was promoted as the perfect middle ground, more affordable than major metros, yet far healthier than struggling Rust Belt towns nearby. But that balance slowly slipped out of place. Over the past few years, buyers who had been priced out of larger markets began turning their attention to Lancaster as the next best option. Remote workers, long-distance commuters, and investors all showed up with the same mindset. They bid aggressively, offered over asking, waived protections, and pushed home prices well beyond familiar territory. The problem is that local incomes never made the same leap. That disconnect is now showing up clearly in the listings. Homes that once would have disappeared within a weekend are now lingering, often after multiple price reductions. Sellers start high, hear nothing back, and then cut prices in noticeable steps. Properties near downtown or within top school zones still draw interest, but anything just outside the hottest areas, or anything that needs serious work, ends up waiting much longer than expected. Lancaster's housing stock adds another layer of risk. Many homes look stunning in photos, but owning them can be expensive in reality. Aging plumbing, outdated electrical systems, worn roofs, and inefficient windows are common issues. During the buying frenzy, plenty of buyers told themselves they'd handle those problems later. That later has arrived, and repair costs, both labor and materials, are far higher than most people anticipated. The rental market tells a similar story. Investors who assumed rents would keep climbing non-stop are running into pushback. Tenants can only handle so many increases before they start looking toward nearby townships where costs are still lower. Even one vacant unit can erase months of projected gains, especially as property taxes and insurance continue to rise. Lancaster hasn't lost its charm, but buying here right now means stepping into a market that's slowly correcting downward while ownership costs keep moving up. What once felt like a safe bet now looks more like a balancing act, less a sure thing and more of a tightrope. Number 9. York. For decades, York has existed just outside the orbit of larger cities, Harrisburg to the west and Baltimore a manageable drive to the south. That positioning once made it an under-the-radar option for buyers who wanted more space for their money and didn't mind commuting. During the housing boom, though, York found itself in a very different spotlight. Investors and newcomers took notice of the low purchase prices and sturdy old architecture. They poured money into renovating brick homes, carved larger houses into multiple rentals, and routinely paid more than local buyers ever could. For a brief stretch, it felt like York was finally seeing the appreciation it had missed out on for years. But beneath that surge, the local job market wasn't evolving at the same pace as home prices. As interest rates climbed and inflation started shrinking paychecks, those limits became hard to ignore. Many listings across York now sit longer than sellers expect, often accompanied by a trail of price cuts. It's a clear sign of owners adjusting downward as buyers grow more selective and cautious. Homes with maintenance issues, awkward floor plans, or less desirable locations are taking the biggest hits. York also carries the weight of its industrial past. Older properties often come with environmental concerns, outdated mechanical systems, and years of deferred upkeep. Insurers are paying closer attention to flood exposure, drainage problems, and fire risks tied to aging buildings. That scrutiny translates into higher premiums or stricter terms, which can make both buyers and lenders uneasy. Add in property taxes that feel heavy compared to local incomes, and affordability becomes more than just a mortgage issue. Buyers are forced to look at the entire monthly cost: principal, interest, taxes, insurance, and utilities that run high in older, drafty homes. When that combined bill creeps toward half of a household's take-home pay, many simply walk away. York still offers real opportunity, especially for those who understand its neighborhoods block by block. But the era when low prices alone made it an obvious buy has passed. Values are drifting back toward levels locals can realistically manage, and anyone who bought near the peak is feeling that adjustment in real time. Number 8. Erie. Erie sits along a stretch of freshwater coastline that, on paper, should be a lasting advantage. A working lakefront, public beaches, and sunsets spilling across Lake Erie. It's the kind of natural setting most cities would kill for. Yet the housing market paints a far more complicated picture. For years, Erie wrestled with population decline, unstable employment, and long-term neglect in several neighborhoods. When the recent housing surge hit, a modest but noticeable wave of interest followed. Outside buyers and local homeowners looking to trade up saw the same appeal. Prices were low, the lake was stunning, and getting in early might mean riding a long-awaited comeback. That rebound has been uneven at best. By 2026, the downward pressure is hard to miss. A handful of renovated pockets near downtown and along key corridors are still holding up, but even those areas are seeing prices edge lower as buyers push harder at the negotiating table. Move farther out, where aging single-family homes and worn duplexes dominate, and the softness shows up faster. What starts as a small price trim often snowballs into cuts of $10,000 or $20,000 once sellers realize demand is thinner than expected. Erie's climate adds another layer of strain. Harsh winters bring real maintenance costs: snow and ice-damaged roofs, moisture creeps into basements, and constant freeze-thaw cycles wear homes down year after year. Owners who bought with little financial cushion are discovering that one major repair can quickly tip their budgets into the red. That pressure feeds more distressed listings, which in turn drags comparable prices lower. The rental market doesn't provide an easy fallback. Many local renters operate on tight incomes, and there's a clear ceiling on what the market can support. Meanwhile, heating older buildings through long winters is expensive. Landlords face a tough choice: spend heavily on upgrades and wait years to recover the cost, or absorb higher utility bills and hope vacancies don't spike. Erie will always have the lake, but that natural beauty doesn't cancel out the structural challenges baked into the housing market. Right now, prices are adjusting to what the local economy can realistically sustain, and anyone banking on quick appreciation is learning that lesson the hard way. Number 7. Bethlehem. Bethlehem is a city shaped by steel, and by its ability to reinvent itself. The blast furnaces no longer roar, but the massive industrial footprint has been repurposed into arts, spaces, offices, and tourist destinations. For years, the prevailing narrative was that Bethlehem had figured it out. It offered a walkable historic downtown, a strong university presence, and convenient access for buyers coming from New York and New Jersey. That success, however, created its own set of challenges. As buyers from downstate and out-of-state searched for cheaper alternatives, Bethlehem landed squarely in their sights. Row homes that once sold at reasonable prices suddenly sparked bidding wars. Modest single-family houses in desirable school zones saw sharp jumps in value. Investors rushed in, snapping up student housing and short-term rentals under the assumption that demand would keep rolling. Now, the market is showing signs of strain. In several neighborhoods, list prices no longer line up comfortably with what local incomes can support. Sellers who set expectations based on peak sales from a year or two ago are finding themselves stuck on the market longer, often forced to make steeper cuts. Buyers are thinking twice about homes on busy roads, tight lots, or properties that require major renovations. There's far less room for missteps than there used to be. Bethlehem also faces a unique combination of pressures. Demand tied to students, festivals, and tourism can dry up quickly when the economy slows, or people scale back discretionary spending. Traffic congestion and parking headaches in popular areas turn off buyers looking for a quieter, more residential lifestyle. In response to complaints about noise and short-term rentals, homeowners associations and local governments have tightened rules, which changes the math for investors. For those who bought at peak prices, a cooling market isn't just an abstract trend. It raises real concerns about whether selling would mean taking a loss. Longtime residents feel a different squeeze, as higher assessments and tax bills driven by past price spikes collide with wages that haven't kept pace. Bethlehem isn't crashing in any dramatic sense, but it is cooling in a meaningful way. It serves as a reminder that even cities with genuine revitalization can become stretched too thin when too many buyers assume the upward trend will last forever. Number 6. Scranton. For years, Scranton has been treated as shorthand for old economy decline. Closed factories, campaign talking points, and pop culture references have painted it as a symbol of working-class Pennsylvania left behind. That reputation misses an important detail. The housing market here did move, and in certain neighborhoods, it moved more than many expected. As prices climbed across the rest of the state, Scranton's low barrier to entry started turning heads. Buyers with limited savings realized homeownership might actually be within reach. Investors spotted opportunity in aging multi-unit buildings. For a while, there was a cautious sense of momentum. New shops appeared, some streets cleaned up, and sales data showed real improvement. The underlying economy, however, remains fragile. Many jobs in the region pay enough to cover the basics, but not enough to comfortably support a large mortgage or fund major renovations. When interest rates rose and inflation pushed up the cost of essentials like groceries and gas, households that had stretched to buy found themselves living on a knife's edge. By 2026, that pressure shows up in quiet but telling ways. For sale signs stay up longer. Deals fall apart after going pending when financing doesn't hold. Price cuts have gone from occasional to routine. Sellers who price realistically for their home's condition and location still find buyers. Those hanging on to boom-era expectations are left waiting, often indefinitely. Scranton's aging housing stock adds another complication. Many homes are oversized, outdated, and expensive to modernize. Bringing them up to code and making them energy efficient requires serious capital. Investors who underestimated those costs are feeling the consequences now. Empty units and stalled renovation projects weigh on nearby property values and remind buyers that cheap doesn't always mean good deal. There are still pockets of Scranton where a careful, well-researched purchase can make sense. But the assumption that low prices automatically equal safety has been shattered. Values are sliding, especially in weaker areas, and anyone who believed they could always pass the property to the next hopeful buyer is discovering just how thin that safety net really was. Number 5. Reading. Reading sits in a valley that has watched one economic cycle after another roll through and then move on. It was once a manufacturing stronghold, later repositioned as a logistics and warehousing hub, and it has spent decades trying to reinvent itself yet again. The housing market has followed each of those shifts, rising and falling right along with them. In more recent years, Reading attracted a mix of longtime residents trading up and buyers from outside the area searching for value. With rail lines and major highways nearby, it looked like a practical option for people working remotely part of the week or commuting only part-time. Prices climbed off rock-bottom levels, and that rise created the impression that the market had finally found solid footing. That sense of stability is being challenged now. Scroll through current listings and you'll see homes sitting for months, with prices ratcheting down in stages. Foreclosures and distressed sales never fully went away, and in some neighborhoods they've become common again. Higher interest rates, climbing property taxes, and wages that haven't kept pace have pushed some late-cycle buyers past their breaking point. On top of that, concerns about crime and school quality play an outsized role in buyer decisions. Families may stretch their budgets for the right district, but they won't hesitate to walk away if they feel their children's safety or education could be compromised. The result is a sharp split between areas that manage to hold value and others where prices are sliding quickly. For investors, the path has narrowed as well. Plans to stabilize rough properties and then flip or refinance into friendlier loans are running into headwinds. Appraisals are tighter, lenders are more cautious, and renters have no room left in their budgets to absorb increases. Even modest, unexpected expenses can turn a deal from marginally profitable into a loss. Reading is a clear example of how a market can weaken rapidly, even when it still appears cheap at first glance. The real benchmark isn't coastal cities, it's what local residents can realistically afford. By that measure, prices are edging lower, and it's still unclear where they'll finally settle. Number 4. Harrisburg. As Pennsylvania's capital, Harrisburg has long carried an aura of built-in stability. State government jobs, law offices, lobbying firms, and the industries that support them created the sense that this was a dependable place to own real estate. When other housing markets swung wildly, the assumption was that Harrisburg would just keep moving forward at a steady, uneventful pace. That belief is now being put to the test. During the boom years, development surged along the riverfront and spilled into nearby neighborhoods. Renovated row houses, newly built townhomes, and expanding suburbs all rode the wave of cheap borrowing and demand from remote and hybrid workers. Prices climbed, bidding wars became common, and the old idea of Harrisburg being boring but safe gave way to something much closer to fear of missing out. With higher interest rates and household budgets under pressure, the slowdown is becoming harder to ignore. Homes with river views or access to top-rated schools still attract attention, but much of the broader market has cooled. Price reductions are routine, days on market are stretching longer, and sellers who expected immediate offers are learning the art of patience and negotiation. Harrisburg also sits at the crossroads of real environmental and infrastructure risks. Living near the river is appealing during calm seasons, but heavy rainfall and upstream runoff raise concerns about basements, foundations, and long-term damage. Insurance providers track those risks closely, adjusting coverage and premiums accordingly, and buyers factor those costs into what they're willing to pay. The spread of suburban development around the capital adds another complication. Homes farther out may offer more space, but they rely heavily on affordable commutes and smooth highway access. As fuel prices, tolls, and vehicle upkeep rise, long daily drives lose some of their appeal. That could shift demand back toward the city center, but only if prices and perceptions of safety remain reasonable. At the moment, Harrisburg feels like a market in transition. It isn't collapsing, but it is clearly recalibrating. The people most exposed are those who assumed the state capital label alone guaranteed long-term security. In an environment where financing costs and climate-related risks are rising together, no city gets an automatic pass. Number 3. Allentown. Over the past decade, Allentown has been heavily promoted as a comeback success story. Downtown redevelopment projects, a new arena, sleek apartment complexes, and constant messaging about a revived Lehigh Valley helped reshape its image. For a while, the data backed up the hype. Rents rose, sale prices followed, and vacancy rates dropped. But that narrative has become far more complex. As new housing units kept coming online and investor interest intensified, the easy upside began to fade. By 2026, Allentown is dealing with what looks less like momentum and more like growing pains turning into real pressure. Some of the newer and freshly renovated buildings are still pulling in solid rents. Others, however, are resorting to incentives, free rent periods, reduced deposits, and special deals just to keep units filled. On the ownership side, buyers have shifted their mindset. They're no longer willing to pay top dollar simply to buy into the revival story. Instead, they're scrutinizing school quality, neighborhood safety, parking availability, and the long-term impact of taxes. Homes tucked into quieter residential areas are holding their value better, while properties along busy streets or high-traffic corridors are seeing more resistance and deeper price cuts. Allentown also reflects a tension common in many mid-sized cities. New investment hasn't wiped out long-standing poverty or inequality. Some blocks feel entirely renewed, while others show little visible change. That uneven reality plays a major role when appraisers select comparable sales and when buyers walk neighborhoods and talk to locals. Layer in higher interest rates, rising utility costs, and steeper insurance premiums, and the room for mistakes narrows quickly. Investors who expected fast flips or effortless cash flow are reworking their numbers. Buyers who purchased near peak pricing are trying to stay patient as newer listings appear at lower prices around them. Allentown isn't beyond saving, but treating its turnaround as a sure thing comes with real risk. Right now, values are falling fastest in the areas where excitement and marketing pushed prices well ahead of what local incomes and everyday conditions can realistically support. Number 2. Pittsburgh. Pittsburgh spent years carefully reshaping its image, moving away from its steel town past and toward a future centered on healthcare, higher education, and technology. The rivers, the bridges, the dramatic hillsides, and the layered neighborhoods all reinforce the idea that this was one of the most overlooked and undervalued cities in the country. That story attracted serious capital. Investors piled into rental properties near universities and major hospitals, while out-of-state buyers looked at trendy neighborhoods and rows of modern townhomes and assumed they were catching the next breakout city early. Prices in once affordable areas like Lawrenceville, the Strip District, and parts of the East End climbed quickly from their historical norms. The debate wasn't whether values would rise, it was how fast they would keep going. That assumption is now being challenged. Prices are adjusting downward, and the pullback is most noticeable in the very neighborhoods that heated up first. Frenzied bidding wars have been replaced by slower, more deliberate negotiations. Sellers who price their homes based on peak sales nearby are being forced to recalibrate. In some cases, deals are collapsing during inspections when buyers uncover more work than they expected, sending those homes back to the market. One of Pittsburgh's longtime appeals has been its distinctive housing stock: tall, narrow homes, classic brick exteriors, and repurposed industrial buildings. But those features often come with significant upkeep costs. Steep lots, aging retaining walls, complex foundations, and outdated mechanical systems aren't cheap to maintain. As borrowing costs rise, fewer buyers are willing to accept those risks at premium prices. The rental market is feeling pressure as well. Student demand shifts with enrollment trends and changing preferences, while healthcare and tech workers are paying closer attention to commute times, neighborhood safety, and nearby amenities. Landlords who bought at elevated prices are discovering that rents have a ceiling. Push too hard, and tenants start exploring other neighborhoods or nearby suburbs. Pittsburgh still has genuine strengths, but the idea that it was forever undervalued is being put to the test. By 2026, it's clear that some areas were bid up beyond what local fundamentals can support, and those who bought near the top are now bearing the cost of that correction. Number 1. Philadelphia. Philadelphia earns the top spot because it compresses nearly every housing pressure facing Pennsylvania into one vast, complicated market. You'll find historic row homes sitting next to luxury high-rises, struggling blocks just a few streets away from booming corridors, and food scenes that thrive in neighborhoods that can change character from one intersection to the next. During the era of cheap money, Philly became a powerful draw for both investors and first-time buyers. Families stretched their budgets to grab small row homes in sought-after districts. Developers pushed new construction and rehab projects across huge portions of the city. Buyers from New York and New Jersey, often arriving with cash and big expectations, flooded in. For a while, prices seemed to rise everywhere at once. That momentum has clearly slowed. In many neighborhoods, values are now moving lower. Homes that once sold almost immediately are sitting on the market, and price reductions have become routine. Properties needing updates, or burdened with quirks like tight staircases, low ceilings, or lack of parking, are seeing the sharpest pullbacks. At the same time, ownership costs keep climbing. Property taxes, utilities, and insurance all take a bigger bite, and older homes demand constant upkeep. Roof repairs, brickwork, plumbing, and heating systems all add up. During the frenzy, many buyers assumed they'd handle repairs later or refinance into cheaper loans. Now that later has arrived, and cheaper financing simply isn't available. Quality of life issues only intensify the financial strain. Concerns about crime, school performance, trash collection, and transit reliability all factor heavily into buyer decisions. Some families who once hoped to buy in specific city neighborhoods are instead choosing inner-ring suburbs, where schools, safety, and services feel more predictable, often for the same or even lower monthly cost. Investors are also adjusting their expectations. Short-term rental regulations have tightened in parts of the city, Tenants are pushing back against rent hikes, and eviction rules, court delays, and maintenance costs complicate what once looked like easy cash flow. Quietly, some small landlords are choosing to sell, even if it means accepting less than they planned, simply to reduce risk. Philadelphia isn't going anywhere. It remains the state's economic and cultural powerhouse. But its housing market has clearly shifted into a phase where prices are bending rather than climbing. That's why it takes the #1 spot on this list of Pennsylvania cities where home values are falling the fastest. So what does this countdown tell us about Pennsylvania right now? From Lancaster and York to Erie and Bethlehem, from Scranton and Reading to Harrisburg, Allentown, Pittsburgh, and Philadelphia, the same pattern keeps repeating. Home prices rose much faster than local incomes. Investors pushed boundaries. Aging homes and outdated infrastructure were overlooked during the rush, only to become costly problems once the bills came due. Now the reset is underway. It isn't always a dramatic collapse. Often, it's a slow grind, price cuts, longer listing times, and incremental losses that stack up for anyone who bought near the peak.